Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. It's Monday, January 26th, 2026. Let's kick off the week with the latest residential and multifamily data. First up, what's hot? And the big story today is supply relief. It is finally here. The headline you need to know. Apartment deliveries are projected to decline a staggering 34% nationally over the next year. This is exactly the supply relief the multifamily sector has been waiting for. And leading this turnaround? Texas. Completions in 2026 are expected to average about 11,700 units per quarter. To put that in perspective, that is roughly half the quarterly volume Texas saw through 2024 and 2025. That's not just a cool down, it's a dramatic shift. This is happening because the pipeline is shrinking, and shrinking fast. New construction starts are down 70% from their peak. Developers are on track to break ground on just 395,000 units in 2026, a drop from 410,000 in 2025, and this is reflected in sentiment. Developer sentiment is finally shifting positive. 70% of respondents in the latest NMHC survey believe conditions will improve in 2026. They're finding that financing is getting a little bit easier, and there's a real feeling that the worst may be behind them. Now, there are always outliers. Select markets are bucking this trend. Los Angeles, for instance, is seeing deliveries nearly double to 15,500 units. Detroit is seeing a 77% increase, with 3,100 units expected. And San Diego and Anaheim are up over 70%. But I want to stress, these are the exception, not the rule. All right, let's pivot to what's not so hot. And it's all about vacancy. The national multifamily vacancy rate hit 7.3% in January 2026. That's a record high for Apartment Lists Index, which dates all the way back to 2017. That's not a typo. A record high. Zooming in, the Denver metro area reached its highest vacancy rate in 16 years. Both Arapahoe and Denver counties are tied at a painful 8.2%. And the Sunbelt markets are still feeling the pain from that supply glut we've talked about for months. Tampa is projected to see negative rent growth continue through the end of the year. In San Antonio, rent growth isn't expected to turn positive until the fourth quarter. The national forecast isn't exactly rosy either. The vacancy rate is expected to hover around 8.4 to 8.5% through all of 2026. We likely won't see it drop below that 8% mark until 2027 or even 2028. So, what does this all mean? Why does it matter? The multifamily market is clearly at an inflection point. On one hand, supply is finally slowing down. 34% fewer deliveries, 70% fewer new starts. But on the other hand, vacancy hasn't caught up with that reality yet. We're in this lag period where the supply relief is real, but absorption simply takes time. Because of this dynamic, rent growth is expected to be modest. The consensus is hovering around 2% for the year, with CoStar projecting just 1% by year-end. You'll see outperformance in the lower supply markets in the Northeast and Midwest, but those Sunbelt markets, they just need more time to absorb all that new inventory. But there is a bright spot. Wage growth and cooling inflation are strengthening real incomes for renters. And we're seeing reduced move-outs to single-family homes, which deepens the rental demand pool. The fundamentals are setting up for a recovery, but patience is absolutely required. So for our investors listening, what's the key takeaway? It's simple. Supply relief is here, but vacancy remains elevated. This is the setup for a 2027 recovery, not a 2026 sprint. You need to focus on low-supply markets. Think Northeast and Midwest. It's probably wise to avoid the high-vacancy Sunbelt metros until we see absorption really start to accelerate. And most importantly, underwrite conservatively on rent growth. That 2% figure is the realistic baseline for now. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.